Welcome to the Explainer. Today we're acting as your specialized analytical engine, and our mission is to completely deconstruct the complex, interlocking web of federal immigration, business, and tax regulations. We're not just going to sit here and summarize the rules for you. No, we're diving deep into the core mechanisms, the hidden cause and effect relationships, and the actionable insights that actually drive compliance on a global scale. We're going to strip away all that surface-level filler to show you how these massive bureaucratic systems really function, starting all the way from the international border right down to your individual tax return. Let's get right into it.
Here is our roadmap for today. We're covering 1. Immigration and security. 2. Establishing a U.S. business. 3. Navigating international tax law. And finally, 4. Domestic credits and enforcement. Section 1. Immigration and security. Okay, let's dive into this first piece. The number 30 here represents the sheer massive scale of federal security mechanisms. Think about it. When major global sporting events happen, federal agencies don't just secure the ground. They implement a strict 30-mile no-fly perimeter to completely control the airspace. But the security apparatus extends way beyond just physical threats. At the exact same time, these same agencies are deploying specialized officers who are actually trained by trademark holders to intercept counterfeit goods. The key analytical insight to pull from this is that national security operates on multiple intersecting planes. They are testing the perimeter of both physical airspace and intellectual property simultaneously. Now, once you're actually inside the system, the rules of physical presence become incredibly specific. And the absolutely crucial point here is the strict cause and effect relationship between the time you spend abroad and how it can disrupt your legal path to citizenship. See, there's a fundamental difference between just being physically present and maintaining continuous residence. An extended absence of 6 to 12 months, that isn't just a long vacation. Mechanically speaking, it can completely break your continuous residence requirement, which literally forces a reset of the statutory clock you need for naturalization.
So how do federal authorities grant subjective exemptions? Well, they use an objective mathematical matrix. Just look at the data here. If an applicant is 50 years old with 20 years of residency, or 55 with 15 years, the English language requirement drops entirely, though they still have to take the civics test in their native language. But if they're 65 with 20 years of residency, the civics test itself is simplified. What this tells us is that the system operates on the implicit assumption that older, long-term residents have integrated in ways that simply bypass the need for standard linguistic testing.
Which brings us to a really critical pivot point. We've looked at physical immigration, right? But what about virtual economic presence? It begs the question, does registering a U.S. business automatically trigger U.S. income taxes? Section 2. Establishing a U.S. business.
To answer that previous question, no, registration absolutely does not equal taxation. The system actually isolates the type of structure and operations you have. For example, if a foreign consultant creates a single-member domestic entity but performs all their services abroad with zero domestic operations, they typically only file an informational return. It's essentially just a non-taxable data point for the government. Now contrast that with a traditional corporate structure generating domestic profits, which definitively triggers a taxable return. The actionable insight here? Structure dictates liability, always. But you know, the federal level is really only half the battle. Just observe the extreme volatility of local compliance. In a single recent year, analytical reports tracked roughly 3,000 localized sales tax law changes across the country. That's nearly 10 changes a day. For a business operating across multiple jurisdictions, this creates tremendous system volatility. Compliance isn't just some static achievement you unlock. It requires a dynamic, constantly updating data engine to avoid some pretty severe penalties.
Section 3. Navigating international tax law.
Now let's talk about the baseline mechanism for determining tax residency for foreign nationals, the substantial presence test. It's basically a strict mathematical formula that counts the days you are physically in the country. However, and this is crucial for the sports and entertainment industries, the system contains highly specific exemptions engineered just for them. Take a professional athlete competing in a qualified charity sports event, for example. They are explicitly exempted from this day count. Their time-generating charitable value literally does not trigger tax residency. This mechanism reveals a huge implicit assumption in the tax code, which is that cross-border cultural and athletic contributions are incentivized through temporary jurisdictional immunity. So for global entertainers and athletes, leveraging these precise mathematically excluded days is an absolute cornerstone of international financial strategy.
The outcome of that test dictates your fundamental baseline rule. If the formula classifies you as a resident alien for tax purposes, you are definitively taxed on your worldwide income. It doesn't matter where it was earned. But if you remain a non-resident alien, the federal funnel only captures your domestic-sourced income. This is the absolute binary switch that completely alters an individual's entire global financial strategy. For citizens and residents whose worldwide income is captured, the system does create relief mechanisms to prevent double taxation, namely the foreign tax credit and the foreign earned income exclusion, which allows up to $130,000 to be excluded for 2025. But here is the actionable expert-level insight you need to take away. These benefits are not automatic. You have to affirmatively elect to claim them on specific forms. If you just assume the system will automatically protect you from double taxation, you are implicitly assuming a level of bureaucratic benevolence that, frankly, simply does not exist. Now, a similar mechanism exists for Social Security. A totalization agreement is a bilateral international treaty designed specifically to prevent global workers from overlapping Social Security liabilities. But again, the cause and effect here requires action. To actually trigger the treaty's protection, the worker or the employer must obtain a formal certificate of coverage from the foreign government's relevant agency. The treaty exists, sure, but paper documentation is the literal key to unlock it. So, the really crucial point to understand is that actions in one federal system profoundly impact another. Take employees of foreign governments or international organizations. They often enjoy specific tax exemptions on their wages, but there's a massive hidden trap. If that employee decides to pursue permanent residency and signs a specific immigration waiver, the cause and effect is instantaneous. Signing that immigration waiver legally nullifies their international tax exemption. Upgrading their immigration status directly downgrades their tax advantages. We've looked at international treaties and global income, but what happens when we reach the absolute narrowest point of the funnel? What happens when federal authorities decide to audit the exact due diligence of your local tax filings? Section 4. Domestic credits and enforcement. First off, let's categorize the completely fragmented regulatory soup facing independent artists, entertainers, and gig workers today. The federal system purposefully isolates income types to track independent economic activity. Think about it. A single entertainment professional might trigger multiple reporting mechanisms simultaneously. If an artist earns passive royalties from a music catalog, the system generates a 1099 MISC. If that exact same artist works as a freelance stagehand, well, they receive a 1099 NEC for non-employee compensation. And if they sell merchandise through digital wallets, that triggers a 1099K. For anyone in the entertainment industry, understanding this exact fragmentation is the absolute prerequisite for staying compliant. When it comes to domestic credits, the rules are incredibly rigidly defined. Take the adoption credit, for example. The actionable financial mechanism for 2025 limits qualified expenses to $17,280 per child. A specific portion of that is refundable up to $5,000, while non-refundable portions can actually be rolled forward for up to 5 years to offset future liabilities. However, the system enforces very strict boundaries. Expenses to adopt a spouse's child are explicitly excluded. The code favors the creation of new legal families, not the formalization of existing step-parent relationships. And what happens when families clash over who gets to claim those lucrative child-related credits? Well, the federal system does not sit there and evaluate subjective family dynamics. Instead, it deploys a strictly objective mechanism, the AGI tiebreaker rule. If two non-parents, let's say a grandmother and an uncle living in the exact same home, both qualify to claim a child, the law coldly dictates that the individual with the highest adjusted gross income automatically wins the claim. In this system, economics overrides emotion every single time.
Because these rules are so complex, authorities heavily audit professional tax preparers. This right here is the exact sequential process of a due diligence audit. Step 1, the official notification letter arrives. Step 2, the preparer has to submit 25 specific client files, which contain worksheets, questionnaires, and raw evidence. Step 3, an analytical phone interview with an agent. The hidden insight you need to grasp here is that the agent isn't just looking for isolated math errors. They are testing a sample size of 25 to detect systemic patterns of negligence.
And honestly, this strict enforcement is entirely necessary because misinformation spreads like wildfire. A major priority for federal authorities right now is combating the annual dirty dozen tax scams. A prime example is the promotion on social media of non-existent tax refunds, pushing taxpayers to falsely claim pandemic-era sick and family leave credits. These were highly technical credits meant only for specific self-employed workers during a very narrow window in time. Falling for this digital misinformation triggers immediate, severe federal penalties. So look at the journey we just took. We've moved from the 30-mile no-fly zones of national security, navigated the labyrinth of international tax treaties and substantial presence exemptions, and drilled all the way down to the granular audits of domestic gig worker income and family tax credits. These systems are so deeply interconnected that a single signature in one place can instantly trigger a massive liability in another. So the ultimate question we have to leave you with today is this. With constantly shifting international treaties, highly complex exemptions, and strict, unforgiving local audits, is your compliance strategy truly foolproof? Thank you for joining us for this analytical breakdown. Until next time, keep digging into those details.